Hello, and welcome to the opening panel of GFOA's 2020 conference. I'm Emily Brock, Director of GFOA's Federal Liaison Center in Washington, D.C.
And I'm Dan Hughey, GFOA Executive Board Member and Public Finance Director for the state of Indiana. We hope each and every person and your loved ones are well during this trying time. Although I know we'd all rather be in New Orleans, our hearts are with those suffering and in recovery and the first responders that are taking care of everyone. We look forward to the next time that we can be together. Today's online panel is one for the books. Federal leaders from across the country will be joining us to discuss their policy objectives. We're also highlighting the efforts of our federal advocacy team in Washington, D.C. That's right, you heard that. GFOA is in Washington, D.C., in addition to our main office in Chicago, where our federal team heads up all things legislative and regulatory that are in the interest of public finance officers across the country. GFOA is your advocate in Washington, and as you can imagine, this team has been very, very busy lately.
Dan, thanks for the kind introduction. It's true. We have been very busy staying out in front of the COVID stimulus efforts of our federal government and regulatory development dealing with the COVID legislative intent. And thankfully, it didn't require any pivot in our policy or messaging of any kind. We continue to advocate strongly for sustained funding to local and state governments. We push for policies that underpin a strong and stable municipal bond market. We're vigilant on employment and healthcare matters important to government. And we remain focused on public sector pension provisions. And as you know, all of these have come up in various ways in our recent work, and now more important than ever. Today, we're happy to have a panel of policymakers who agree. They are our advocates, they are bipartisan, and they are leaders for our issues.
We look forward to hearing from them, Emily, but first, let's set the stage for GFOA members listening today. March 18th through the 23rd feels like a lifetime ago. Corporate bond market got the attention. It was the municipal bond market where we saw long-term bond offerings frozen up and unable to be sold. We saw rates on our variable rate demand portfolios skyrocket into double digits. What was happening at that point in time? Buyers, even investors in muni bonds, took their cash out of the market and stood on the sidelines. They needed to see what the market was going to do as a result of COVID. And importantly, they needed to see what the federal response was going to be. While all this was happening, Indiana, similar to all states and local units of government across the country, were waiting.
So at that point in time, GFOA conducted a poll of our membership, specifically on March 23rd. Dan mentioned the period of time between March 18th and March 23rd. We really wanted to make sure that we understood the universe of the challenges that our members were looking forward to. So executing this poll on March 23rd, it was still fairly early on in terms of stay-at-home orders and also the precipitous declines in commerce that we've seen lately. We wanted to make sure at that point in time that we understood the severity of the challenges ahead for you, our finance officers. Thinking about it in terms of short, mid, and long-term impact, about 1,100 GFOA members illustrated a few key themes in the survey. In the short term, our members were concerned about increased expenses, particularly cities delivering services in urban areas and the counties operating health systems. In the midterm, projected decreases or delays in revenues are in store, some very dramatic projections. And in the long term, still, finance officers are concerned about lost revenues, but also there are questions that dominate about capital and delayed projects due to market uncertainty. Those seem to be the biggest challenges in our membership.
I can tell you, Emily, that this reflects Indiana's concerns and our local units of government throughout the state. Like you just mentioned, Indiana has seen a drop in our sales tax revenue, our withholding tax revenue. We've also seen a delay in our income tax, both corporate and personal, due to the federal extension of tax filing through July 15, 2020. Our casinos have been closed since the middle of the month, or since the middle of March, and there are revenues from casinos that have now been lost. In addition, our local units of government are also seeing delays in their property tax payments due to an extension of 60 days with no late payment fees for property owners throughout the state.
So how did Congress react to this news of projected challenges in Indiana and across the country? Where we stand today, there have been a series of stimulus bills of interest to state and local governments. So the first, and technically, stay with me, it is technically the second, but the first relating to state and local governments was headed up by the House. And that's called the Families First Coronavirus Response Act. It casts a wide safety net over local communities by providing sick leave guidelines for workers impacted by the virus. And while a refundable tax credit was offered to private sector employers, unfortunately, the credit was not extended to state and local governments, still subject to the mandate. And that would be state and local governments who do pay in to Social Security. So about 75% of public sector employers across the country.
The third stimulus was through the Senate's efforts. They created a $2.3 trillion package called the CARES Act. And while it famously provided $1,200 payments to individuals across the country, which included my 84-year-old mother, it also loaded up many grant programs already in place. It enhanced emergency response grants and FEMA and the Centers for Disease Control. It also provided immediate assistance to infrastructure programs already in place at the Federal Transit and Aviation Administrations. And also important to GFOA members, the CARES Act enhanced the Education Stabilization Fund and secured more funding for coronavirus emergency funding for public safety officials. I'd say the program in CARES that has created the most welcome relief, but also has many questions remaining, is the Coronavirus Relief Fund. This $150 billion program provides funding to states and local governments within those states with a population of greater than 500,000 people. This is for COVID-19 related expenses only. Guidance has been released in 2 separate waves. Each wave is absolutely appreciated, but there are still many questions remaining. Specifically, many GFOA members have requested relief from the requirement that the funds can only be spent on COVID-19 related expenses. Considering the revenue decreases that we've already talked about and are currently experiencing, it would be a welcome relief to show that these funds could also be spent on foregone revenues. In Indiana, approximately 2 weeks ago, we set aside almost $300 million for initial allocation of coronavirus relief funds for our local units of government, counties, cities, and towns. These funds were allocated on a pro rata basis based upon the local unit's population versus the state population. Our program requires a detailed reimbursement form, which you see on your screen. That will be also require supporting documentation for COVID-19 related expenses only. And because of the strict documentation, we believe that will be held to, the state will maintain all documentation for future Inspector General audits of the uses of funds.
Which is incredibly important as we consider that the expected expenses that are going to be spent on the Coronavirus Relief Fund expenses will have to be certified and verified by the Inspector General of the United States Treasury. So herein lies the conundrum. Ensure that there is sufficient guidance on the front end so that come December 31st, 2020, the Inspector General is able to certify the use of those funds. So that still is a major consideration for many of the recipients of the Coronavirus Relief Fund. across the country today. So last but not least, I wanted to touch on the market provision included in the CARES Act. That is the municipal bond market provision. Senator Menendez tirelessly ushered this provision through to the end, right around March 24th, 2020, when the CARES Act was being considered. His leadership, along with many others in the Senate, provided a newly formed policy that establishes the federal government as a lender or as an investor in municipal bonds. Specifically, this provision of the CARES Act allows for the Federal Reserve to provide a backstop to the municipal market. This is something that has never been done before and is an unprecedented event. As we continue to finesse what this means through the development of the Municipal Liquidity Facility, which we will talk about later on in this presentation, Senator Menendez's steadfast urging of action from the Federal Reserve and the Treasury Secretary on behalf of issuers across the country has been critical throughout the crisis.
And now it's my pleasure to introduce the senior senator from New Jersey, Senator Menendez. He's a strong advocate for the people. Senator Menendez is a member of the Senate Banking, Housing, and Urban Affairs Committee and ranking member of the Subcommittee on Housing, Education, and Community Development. He also serves on the Financial Institutions and Consumer Protection Subcommittee and the Securities, Insurance, and Investment Subcommittee. The committee oversees issues related to banking, insurance, financial markets, securities, housing, urban development, mass transit, international trade and finance, and economic policy.
Oh
Not
boy.
Senator Menendez championed municipal bond stabilization efforts during the CARES Act. His bipartisan efforts have now extended to new common sense efforts to build upon the Coronavirus Relief Fund to provide new funding critical to the pandemic response efforts. Without further ado, Senator Menendez.
Well, thank you, Dan, and good afternoon, everyone. Thank you to the Government Finance Officers Association for having me at your virtual conference. And thank you for your tireless work to keep our state and local governments running and providing the critical public services that our residents need, especially during this extraordinary time. And before I get into my remarks, I just want to say what an incredible advocate you have in Emily Swenson-Brock. It's been a pleasure to work with her and her team to craft policies that are responsive to the needs of our communities, and you should all be very thankful to have her on your team. Before coming to Congress, I was a mayor. I served on my local school board and the state legislature in both houses, so I've seen firsthand the challenges that you face at every level during normal times. But these aren't normal times. And I don't have to tell you the pressure that our states and cities and counties are under these days as we as a nation combat COVID-19. I've heard from governors, mayors, county leaders, school officials. Each one has had to expend enormous resources beyond what they budgeted to meet the challenges of the day, while simultaneously seeing tax revenues vaporize. All revenue resources are down. Sales tax revenue is down with business closed. Downtown parking meters are going empty with less people venturing out. Building permit and municipal court fees have fallen off. And with so many out of work, it's becoming increasingly difficult for families and small businesses to pay income and property taxes. And as you all know, if you have all this money going out and little coming in, it's a recipe for fiscal disaster. My home state of New Jersey has been hit particularly hard. We have lost over 10,000 of our neighbors, our friends, our loved ones and we're second only to New York in the number of cases. And because our Governor Phil Murphy took early and necessary actions to flatten the curve and contain the virus, so our hospitals and healthcare system wasn't completely overrun, our economy has been devastated. And now the essential services our residents and businesses depend upon, and what will make our communities continuing great places to live, to work, to visit, and shop, are in jeopardy. At a moment when their jobs have never mattered more, when demand is high for first responders, public health, and social services, communities are struggling to pay police officers, firefighters, paramedics, teachers, sanitation, and other critical public workers. And while the pandemic is affecting some places worse than others, there isn't a place in America right now that isn't or won't be impacted. Our state and local governments can't do this alone. A national emergency requires a national response. That's why when we saw the municipal bond market get thrown into turmoil in March, I acted quickly to introduce a bipartisan amendment to the CARES Act to allow the Federal Reserve to step in and provide urgent liquidity to calm the markets. The final language in the CARES Act wasn't exactly what I wanted, but it was certainly a step in the right direction. And despite all its flaws, the Fed's municipal liquidity facility has given some bond issuers some breathing room, but it's still not enough. The Fed's facility still only covers a sliver of the $4 trillion municipal bond market. This is a major crisis that is having enormous public health and economic impacts. And what we want, and if we want to restore the long-term health of our economy, we're going to have to make it easier for state and local governments to invest in its infrastructure and public services that our local economies rely on. That's why last week I led a bipartisan letter to Secretary Mnuchin and Fed Chair Powell, asking them to stand up another facility to stabilize medium and long-term municipal bond costs. As a matter of fact, Chairman Powell will be before the Senate Banking Committee, of which I'm a member. I believe it's tomorrow, and I intend to ask him about some of these issues we're talking about. Just like in the aftermath of the last financial crisis, state and local spending is going to be a key determinant of whether we have a quick recovery that makes the right long-term investments, or if federal stimulus is going to be offset by cuts in our local governments and plunge us into a long recession. We don't want that. So my focus is on making sure that you have all the financial support you need to make the right investments for our communities and help get our country back to work. That's why I've been working with Senator Bill Cassidy, my Republican colleague from Louisiana, to introduce the bipartisan state and municipal assistance for recovery and transition fund. We call it the SMART Fund because it's just plain common sense. It provides $500 billion in flexible funding to states and communities, with priority given to areas of the country with the greatest need, based on COVID-19 infection rates and lost revenues due to the economic fallout. That's what the bipartisan members of the National Governors Association have been calling for, and what the SMART Fund delivers. And I also appreciate that the National Association of Counties is supporting our legislation. Not only that, we fixed the problem with the $150 billion in state stabilization funds that Congress authorized under the CARES Act. The SMART Fund will retroactively overturn the U.S. Treasury's erroneously restrictive guidance, giving state and local governments maximum flexibility to respond to their most urgent needs. And we eliminate the 500,000 population threshold in the CARES Act to ensure that every county, municipality, U.S. territory and the District of Columbia is eligible for direct funding regardless of their size. These flexible federal dollars can help dramatically expand the testing and contact tracing we need to contain the virus and restore consumer confidence that the risk of infection has been mitigated to the point where it's safe to get back to some semblance of normal life. It will help stave off massive layoffs and deep, painful cuts to essential services, because it's not only about defeating COVID-19. We need to keep our streets safe, our kids learning in school, the buses and trains running on time, the essential public workers we need to get through this on the job. The federal government has to play a forceful role here. It's the only entity big enough to provide the firepower we need. But the private sector can help as well. So I'm going to keep pushing on another bipartisan bill I've led for the past 5 years to encourage greater investment in money market mutual funds. I don't have to tell you how important these funds are to our local governments, both to manage their own cash as well as a source of financing for infrastructure and public services. For years, I've heard finance officers in New Jersey at all different levels of government tell me how the rule changes that came out after the financial crisis, while well-intentioned, made these funds less useful for local governments and failed to create greater overall financial stability. So I would encourage you all to continue speaking to your representative in Congress on the need for reform and more private capital flowing to our states and our cities. And I would just close with this. This virus doesn't respect state lines or political boundaries. It doesn't see red or blue, and it infects a person. Each and every state and local government in America is or will be affected. No one is immune. The federal government cannot sit back and let them go bankrupt. It must do more, a lot more. Certainly, if we're going to defeat COVID-19 and send our economy on a glide path to recovery. Now, I've been in Congress for a quarter of a century or so, and I've seen America overcome some difficult challenges in my time in Congress. But after September 11th, we built a national intelligence and homeland security system that has averted another strike on the homeland. After the 2008 financial collapse, we created new safeguards against systemic risks and gave consumers a champion in the Consumer Financial Protection Bureau that has saved consumers billions of dollars. After Superstorm Sandy here in New Jersey devastated my home state, we built New Jersey back. We made our beaches more resilient and our communities stronger than before the storm. And after COVID-19, we will be better prepared and more resilient in our public health infrastructure. So I see a rising sun on the United States of America, not a setting sun. And together, working together, we're going to make it the brightest sun we've ever seen. Thank you very much for having me. Thank you for the work that you do. And I wish you and your families good health during this difficult time.
Thank you again, Senator Menendez, for the inspirational thoughts. Certainly an excellent reminder to know of the firepower we do have in Washington and the advocates that we do have behind our backs. Thank you so much, Senator. Appreciate it. I wanted to take one quick second because we are going to be hearing from the co-sponsor of the SMART legislation that Senator Menendez mentioned. The SMART Fund, as Senator Menendez suggested, it increases flexibility for states and local governments to use funds to plug revenue losses due to the COVID-19 outbreak. And it targets additional funding toward the coronavirus hot zones in order to combat the pandemic head on. And it does that in a very strategic way, as Senator Menendez mentioned. 1/3 of the $500 billion fund would be provided to eligible entities based on population size in order to ensure they each receive additional federal resources to meet their growing needs. The second third goes to eligible entities based on the number of COVID-19 cases relative to the U.S. population to target the urgent public health challenge. And the final third goes to eligible entities based upon state revenue losses relative to pre-COVID-19 projections in order to target the urgent economic challenge ahead.
We had the opportunity to talk with Bill co-sponsor, Louisiana Senator Bill Cassidy, about the bill, asking him to reflect on the crisis management that has happened in Louisiana. As the senior senator for the state of Louisiana, Bill Cassidy has been a strong advocate for financial transparency in issues pertaining to state and local governments. He led a heroic effort during the response to Hurricane Katrina, and holds valuable insight into the role state and local governments. He led a state and local governments play in crisis management. Notably, he is a member of the United States Senate Committee on Finance, the United States Senate Joint Economic Committee, and the United States Senate Committee on Health, Labor, and Pensions. His perspectives and his leadership at this point in time is especially welcome for state and local government efforts. Let's listen in to the conversation here.
Good afternoon, Senator Cassidy. We appreciate the time you're taking to join us today. Your leadership has put some important issues for state and local governments front and center as stimulus efforts have advanced. Thank you for that.
Thank you.
Although GFOA members, finance officers in Louisiana and across the country have persevered, I know our membership is disappointed in missing out on our conference in New Orleans. You've spent nearly all your life in Louisiana, which includes a stint in the state Senate. Did your time in the Louisiana Senate influence your perspective on the role of state and local governments in times of crisis?
Absolutely. I came in just after Hurricane Katrina. And so Hurricane Katrina was so overwhelming that it was sometimes difficult to make a decision because events were coming so quickly. What it taught me was the need to see over the horizon. You couldn't just look at that event pressing on you. You had to think, wait a second, what is 5 steps down? If I take care of that, then these next 4 steps become so much easier. So being able to observe the response to Katrina outside of government, then stepping in, I always keep those lessons. Yes, take care of that which is before you, but also think of that which is 4 steps beyond. If not, your work never ceases, you never recover. If so, that's when you begin your recovery.
Thank you. If I can ask the $500 billion question here, Senator Cassidy, you have co-championed the effort of the SMART Act, specifically citing the need to further assist state and local governments. What issue or concern has been the driving factor behind this bipartisan bill?
I call it the thin blue line bill, because if we don't support state and local governments, you're going to start seeing essential services let go. Shreveport, Louisiana, eliminating 54 police officer positions as part of a $3 million cut to the overall police department, which is part of a $20 million cut to overall city government. That's Shreveport. That's not New Orleans. New Orleans was really hard hit. Now, if you just think about that, we in Congress have put money for individuals, for small businesses, for the employers, if you will, to keep families employed, to keep them going. But if you don't have that thin blue line to keep people safe, then all that money we put to the small business, poof. Who is going to open up a store if they don't think their premises are safe? Garbage. If the garbage is not picked up from in front of the restaurant and rats scurry around in that which is normally taken away, who's going to go to the restaurant? So anyway, I just think we need to think about what we've done and make sure we continue the process.
Terrific. Definitely connected elements that make a vibrant, healthy community. So, Senator Cassidy, how important is financial transparency during a crisis, and what role does accountability have as effective response measures to crisis?
Nothing undermines support for more aid without financial transparency. And if you can find just a few high-profile examples of egregious abuse, if it's only 1% of what's going on, that's going to undermine support, even though the other 99 has been spent well. Financial transparency is key, both as a steward of taxpayer dollars, but two, to build trust for further expenditures if they are necessary.
Senator Cassidy, we really appreciate your time today. We're so grateful for your leadership and for your support of state and local governments. Thank you.
Hey, thank you, and thanks for allowing me to address. And anybody who wants to come to New Orleans anyway, let us know. We need the revenue.
Will do. Thank you, Senator.
Thank you.
So that brings us to today, Emily. Has anything happened this week? That's kind of a dumb question. Of course, something's happened.
The rhetorical question. Yes, actually, Dan, it's funny you ask. This past week, the House responded to the CARES Act with the next stimulus effort, and they're calling it the HEROES Act. It's an acronym for a significantly longer worded bill. This sweeping legislation addresses many of the challenges ahead for state and local governments. It provides $915 billion in new funding to state and local governments. Those above 50,000 in population, and it also has allocations to tribal governments and territories of the United States. It provides the money in two different tranches, separating the distribution in order to affect the needs next year from those revenue losses that we will be experiencing this year. It separates the distribution by states, cities, and counties in order to minimize the fund distribution challenges we saw with CARES. Again, there was a bit of a challenge in distribution of the CARES Act money, the Coronavirus Relief Fund, simply because of the connected relationships between cities and counties who were eligible entities to be recipients of the Coronavirus Relief Fund. And the HEROES Act, importantly, provides the $915 billion can be spent on lost or foregone revenues for states and localities.
Okay, Emily, you've piqued my interest. What else does the HEROES Act propose to do?
Well, it also addresses other provisions that are important to state and local governments, and importantly are written into our policy guidelines and the work that we do here, it representing GFOA membership. So the most important thing that it does is it addresses initially a challenge that was presented in the second stimulus bill. That was the Families First Coronavirus Relief Act. There is a portion of the HEROES Act which supports state and local leaders to allow to have access to the refundable tax credit for the paid sick leave requirement. And we will be hearing from Representative Schneider soon, the champion of that effort. But in addition, it includes what we call the Safe Banking Act. And what that does is it allows cannabis-related legitimate businesses and their service providers to have better access to banking services, insurance, and other essential financial products. It additionally eliminates the cap on the state and local tax deduction, or what we've been calling the SALT deduction, for individual income earned in the 2020 and 2021 calendar years. If you recall, the SALT deduction, the cap on deduction for state and local taxes was set at $10,000 per taxpayer in the 2017 Tax Reform Act. And last but not least, it expands the employee retention credit to allow state and local governments to claim it in the event that they're paying wages to employees while their operations are fully or partially shut down.
That sounds like a lot, Emily, and a huge effort on behalf of state and local governments. But what I didn't hear is a few key provisions that I was hoping would make it in. I know Indiana and the majority of our GFOA members could really benefit immediately if the full restoration of tax-exempt advance refundings of our municipal bonds was also included in this bill.
And Dan, that is totally fair, and it echoes the sentiment of many of our membership as I'm keeping connected these days. What I would say in response to that is that this bill is intended to address the most immediate needs of state and local government. It does leave the door wide open for a comprehensive discussion on infrastructure, I think, in the very near term. And the reason for that is because we have some very strong champions in the House of Representatives, seeing that the infrastructure priority is followed through, all while looking out for us in the present. As many of you know, the House Municipal Finance Caucus is a bipartisan caucus of 30 members with the expressed mission to think strategically about empowering local government with the ability to make decisions that promote infrastructure investment, promote job growth, and promote economic prosperity. And importantly, for GFOA members out there staying in touch with your delegations, they're actively recruiting new members.
It's really good to know that we have a caucus looking out for us. Sounds like we have both co-chairs of the House Municipal Finance Caucus joining us today. Democratic Congressman Dutch Ruppersberger and Republican Steve Stivers. It's pretty refreshing that our initiatives are bipartisan. Let's hear first from Congressman Ruppersberger, representing Maryland's 2nd District. The congressman is serving his 9th term in the United States House of Representatives for the citizens of Maryland's 2nd District. He co-founded the Bipartisan Municipal Finance Caucus to discuss opportunities and challenges facing state and local units of government to independently fund initiatives that strengthen their communities and to advocate for bipartisan policies that enhance their access to the capital markets. He has also been a strong advocate for restoring advance refunding. We had the opportunity to talk with the congressman on Friday, and let's listen in to that discussion.
Thank you for your leadership on the House Municipal Finance Caucus and for being a champion on our efforts on advance refunding. Unfortunately, we noticed it was absent in the HERO Act. How might we be able to support your efforts on that front?
As you know, I co-authored bipartisan legislation to address this issue with Republican Congressman Steve Stivers of Ohio, who co-chairs the caucus with me. We should empower governments to refinance outstanding bonds, thus reducing their borrowing costs and freeing up resources for other community improvements. This is especially true amid this pandemic, when county and state governments are facing unprecedented revenue losses. Our bill specifically reverses the changes made under the tax reform law of 2017, restoring the tax exemption for advance refunding bonds. We pushed really hard to get it included in the HEROES Act, but were unfortunately unsuccessful. Like you, we were both disappointed, but not necessarily surprised to see our bill didn't make the final cut. That said, I think our chances to restore advance funding through our bill are huge in the very near future, thanks to widespread understanding and appreciation of the municipal bonds and what you do to create infrastructure across the country. And I say our bill because of your group's tireless efforts to raise the profile of the legislation. And I thank you for that. So that's the bad news. The good news is that the bill does include provisions that will help stabilize municipal bond markets. This is a $3 trillion package, and there's almost $916 billion in direct aid to state and local governments. This will at least start to cover municipal revenue shortfalls due to the coronavirus response in Maryland and across the U.S. You are on the front lines, and the market needs to be stable for you. HEROES is a true lifeline for municipal governments who are experiencing hectic drops in sales tax revenue, protracted filing deadlines, and unforeseen costs related to COVID-19. Reinforced cost sharing for unemployment benefits will go a long way as well, helping states and local governments repair their balance sheets. This will in turn help restore investor confidence.
Is there an alternative as strong as the Muni market for state and local governments to utilize?
Truthfully, I would have to say no. I've heard the idea of Treasury lending directly to states, but this is not necessary. The first municipal bond was issued tax-free in 1812, and they have worked ever since. It's the best example of fiscal federalism.
Why is market stability important? What happens when state and local governments must rely on an unstable market?
There's so much at stake here. Increasing the cost to borrow capital means less investment in vertical and horizontal infrastructure and higher property taxes, and nobody wants that. Unfortunately, over the past month, the municipal bond market has experienced a level of stress not seen in over a century, by some metrics worse than both the Great Depression and the 2008 financial crisis. In a typical week, state and local governments issue between 8 and 10 billion in new bonds. We've seen about 1/3 of that in recent weeks, creating more than 35 billion in backlog issuances. Yields on municipal bonds have been driven to levels never before seen in relation to U.S. Treasuries of similar maturities. Investors in the secondary market have redeemed their bond holdings at record-breaking speed. So that's why Congressman Stivers and I want a letter to the Federal Reserve last week asking them to provide at least another $35 billion in CARES Act funding to support the municipal secondary market and fully reopen the municipal primary market. The CARES Act requires the Fed and Treasury to use a portion of the $454 billion Economic Stabilization Fund to assist state and local governments. We want more. Our state and local governments are on the front lines fighting this virus. We have to give them the resources they need to fully serve our communities. Congressman Stivers and I were joined by 41 other members in our bipartisan letter. With all that is going on, and in that political climate, that's an incredible accomplishment.
I'm glad we have such a great friend at the GFOA. His leadership is critical these days.
Oh, for sure, Dan. I've got to say, Congressman Ruppersberger's leadership has been essential at this point in time, and he joins a whole host of many advocates, I would say, in the House. A couple things that we've talked about up until this point. Number one, twice now, congressional officials have mentioned letters, and they call them dear colleagues. I just wanted to share with the folks what that means. A dear colleague letter is a fairly simple communication that goes from either a single legislator or a group of legislators to the entire legislature to have a better understanding of where they stand on positions. And as Senator Menendez mentioned, his dear colleague was directed towards, it was a bipartisan letter. It was directed towards Chairman Powell and to Secretary Mnuchin. And specifically, it was asking for a additional facility to be set up to purchase municipal bonds off the secondary market. Then Congressman Ruppersberger mentioned his dear colleague. It actually said something very similar. It said, CARES Act passed, and we think that the Federal Reserve has the capacity to do a little bit more. And they were hoping that the Federal Reserve, in this bipartisan letter, it was a communication from Congressman Ruppersberger and Congressman Stivers, a bipartisan letter that helped the Fed, and it was sent to the Federal Reserve, and it suggested that it's important for the Federal Reserve to have a bit more action based on what the CARES Act did. And so, therefore, you're going to see a lot of letters and a lot of championing events before we see consideration for the legislation to occur. One thing I did also want to talk about quickly about the process of passage. So far, what's probably evident to folks watching, and certainly for those keeping up with the news, it's like watching a tennis ball. It's a very thrilling tennis match where the House has the first action. The House is the first to introduce legislation, and they pass the Families First Coronavirus Relief Act, and they pass the ball over to the Senate. The Senate then responded with the CARES Act, the $2.3 trillion relief package. Now the ball is back on the side of the House. So you've got the HEROES Act that has been proposed and hasn't been voted on, has not been sent yet over. Actually, it did pass, and it has been sent over to the Senate. So for what it's worth, I think what's really important is not only a sign of bipartisanship is important, but also what's really critical at this point in time is that there's bicameral support for legislation. So if legislation starts off in the House, it's important that there's buy-in from the Senate side in order to pass that legislation. Say the House is able to lob a ball over to the side of the Senate court. Senate would have to pass that legislation, and then the legislation has to go to the executive. The president has to sign the bill in order to enact the bill. And oftentimes what's built into this legislation is recommendations for distribution or recommendations for action. So in the CARES Act, for example, many of the allocations, much of the money that was distributed had a requirement to be distributed 30 days post-enactment. Now, we have a requirement for built into the legislation for the administration to figure out how they are going to distribute the funds. That's exactly what we saw in the Coronavirus Relief Fund. So the $150 billion was passed. It sat over in the United States Treasury, and they had 30 days to figure out how they were going to distribute those funds. And there was a lot of administrative questions, a lot of guidelines, a lot of Q&As that were put out before the statutory requirement of the distribution of the funds. And so there is obviously a very, very important element of distribution of those of the appropriations in order to make it effective for the legislation and for the administration to carry out the legislative intent of the bill.
Emily,
and so, yep.
Sounds like we're maybe in the first set of a tennis match here. We've seen it get popped over. And I think what I'm hearing is this could take a little while for us to get through all these different back and forths.
It will. So even should HEROES Act proceed over to the Senate and get consideration for a vote, it will be still a fair amount of time, at least a month, before you can see implementation of the legislation. So it does sound like we do have Congressman Schneider from Illinois possibly on the line. I'm going to introduce not yet. And so Congressman Schneider, I'm going to do a quick introduction simply because his efforts in introducing legislation and championing our efforts have been pivotal at this point in time. Congressman Brad Schneider represents Illinois' 10th congressional district. Congressman Schneider is a member of the House Committee on Ways and Means in the House. Now, what's really important about being a member of the Ways and Means Committee is that you, as a member of the House of Representatives, have the power of the purse. And so having an appointment on the Ways and Means Committee is absolutely essential. Representative Schneider also serves on the House Committee on Small Business. He is committed to advocating for state and local governments in receiving the resources that they need. Congressman Schneider immediately took the lead in addressing several key provisions critical to ensuring state and local government's pandemic response. Thank you for joining us today, Congressman.
Well, thank you. It's good to be here. I hope everybody's doing okay and is safe and well wherever they might be.
Thank you. Across the country is where we might be today, safely in our homes, hopefully. So, Congressman Schneider, last month with a bipartisan coalition, you introduced the Supporting State and Local Leaders Act, which revises the Families First Coronavirus Relief Act to give employees of state and local government more access to paid, medical, and sick leave. What was so important about getting this done for public servants across our country?
Good. Thanks for the question. Our local governments are literally at the front lines of this battle to beat back the virus and keep our communities safe and sound. Our local governments are responsible for public safety, police and firefighters. They're responsible for sanitation. Ultimately, it gets down to the schools and every other services that all of us rely on. And in the CARES Act, there was a glaring gap, if you will, that private industries were able to get a payroll tax deduction for their employees, but state and local governments weren't. So we wanted to close that gap. It was straightforward. I reached out to a number of colleagues. It's bipartisan. John Katko and Peter King on the Republican side, TJ Cox and Diana DeGette on the Democratic side. We had over 100 co-sponsors. So you saw broad support, especially think about that in this context of where we are now. It's kind of a reflection of the need. But if we're going to get through this crisis, if we're going to hold our communities intact, and then when we get to the other side, whether it's with a treatment or a vaccine, to bring our nation back to both physical and economic health, we need our local governments to be strong and not just the front lines in the crisis, but at the front lines in the recovery.
We appreciate your immediate attention to that because, as you know, Congressman Schneider, it was a big surprise to a lot of employers across the country, and so your immediate attention has been greatly appreciated.
Happy to do it.
Congressman, you've praised the HEROES Act as a bold kind of measure needed to address an unprecedented response effort. Specifically, you have highlighted provisions of the bill that the GFOA has advocated for and supported. How does the lifting of state and local tax or the SALT deduction play a role in this recovery effort?
Great question. And look, I'll start at the beginning. The removal of the deduction for state and local taxes, I think, was bad policy at the start. It puts a double tax on communities. Every community makes a decision of how to fund the services they provide to their neighbors, and it shouldn't be taxed again a second time. Some communities may decide to go on a shoestring budget. Other communities may decide to make bigger investments. That's up to the local communities. But to then apply a federal tax to that, I think is unfair. And it also has a perverse effect. We talked about this last year in many of our Ways and Means hearings. You end up people who can afford to leave because they don't want to pay that second tax leave and put an even increased burden on those in those communities who are struggling economically to carry more of the cost. So it is I thought it was bad policy from the start. That's why I was pleased to be part of the group that worked to provide relief last year when we passed the bill last December. Obviously, the Senate wasn't willing to take it. Now take that in normal times and put us in this crisis at a time where communities are having to figure out how do we get through this? How do we fund the services we need? The demands on firefighter and police services have gone up. The demands on food pantries have gone through the roof, literally. You're seeing lines three miles long. These are the services provided by our local communities. And we're hitting our rainy day funds in our communities where different communities are taking on additional debt. We're going to have to come back and say, we've got to close these gaps. Lifting this tax is good policy now to provide some relief, but even more so as we go forward, as communities figure out how do we address the challenges we face during this crisis and pursue the opportunities we need to ensure a better future for our neighbors and our children. Making sure that we don't have this unfair tax is something that's really important to me. So I was glad we got the relief in the HEROES Act for 2 years. I would have been happier if we could have gotten it completely repealed.
Thank you, Congressman. We have very strong policy supporting that as well. 2017 was quite a heart-wrenching event for lots of folks around the state and local community. And any leadership you have on that Ways and Means Committee is absolutely appreciated by us. So I know our our members appreciate you leading the charge for state and local employees by fighting for their well-being and for resources for state and local government. What can GFOA members do to help you and your partners advocate for the needs of state and local governments as employers?
Sure. I'll be a little bit indirect in my approach here. Well, first, I mean, directly speak up as you're doing and as you have done. It's important that the time you spend in Washington, now spend on calls like this, talking to your local members, your delegation from your respective states. The relationships you build, not just with the members, but with the staff, are really important. And I talk about that in the context of, in normal times, I can have 12 to 20 meetings in a day, every day, and the pace is pretty tight. It's really critical to have those relationships, to understand the nuances of the issue, to understand what specifically for your individual community, for your state, is unique, and what does each member have to advocate. But the other piece I'll touch on, and this was to go a little bit off script, if you will, is I wrote a thought down is know what members know and also what they don't know. You need to be a teacher, right? So each of us come from different perspectives. Every member brings their lifetime of experiences. My experience was not in local government; it was in business. I knew very little about how local governments work before I made it to Congress. It's been a learning process for me. So it's meeting each member where they are, understanding where they're coming from and what biases they might have. And I don't mean that in a negative way. We all come with different biases, and trying to understand those assumptions and move them along in a structured way. And I'll go back to the conversations on state and local taxes. We've had to do that with a number of our colleagues so they understand why it matters to them, and why maybe we're a state that has little or no income taxes. Well, this doesn't affect us. Understanding that actually it affects all the states, and working to get to policies that are fair. So as we move forward through, and I talk about 3 phases of the pandemic: the immediate emergency, trying to bend the curve and get to where we can stand up the resources, the time between now and we have a vaccine, and then ultimately recovery. Understand that each of us come from different places in our own experiences, and you're going to have to be our teachers in that process.
Thank you for joining us today, Congressman Schneider. I have one last question. It'll be an easy one. Cubs fan or White Sox fan?
So it's not so easy for me, and I don't mean this in a political way, but I grew up in Colorado with minor league baseball. I came here for school in 1979. Neither team had won much of anything in those in a very, very long time. So I made a very strategic decision. This was before interleague play. I'm going to root for my American League favorite, the White Sox, and my National League favorite, the Cubs. When we got to interleague play, I said I'll root for the home team when they play each other. And if ever it happens that they make it to the World Series, I will cross that bridge when I get there. So I'm a National League fan more than American League, so I lean Cubs, but I cheer both teams when I have a chance.
We really appreciate your time, sir. Thank you.
Thank you. It's good. And I appreciate all you guys do. Again, please stay safe and healthy, and keep our community strong. It's up to you.
Thank you so much.
Take care.
And now, without a moment's pause, I'd like to introduce yet another champion of state and local government efforts in the House. Congressman Steve Stivers' leadership as co-chair of the House Municipal Finance Caucus has resulted in several bills under consideration. Very importantly, the bill to restore tax-exempt advance refunding. Tax-exempt advance refunding. As well as money market mutual fund reform legislation. I'm so sorry. It sounds like we have Steve Stivers in the House, which is great. Currently serving his 5th term as member of Congress and representing Ohio's 15th congressional district, Steve Stivers has been a champion for state and local government efforts and issues on municipal finance. He has championed efforts through the House Financial Service Committee, resulting in municipal bonds being included as high-quality liquid assets. And finally, he has joined us today. Thank you so much for joining us, Representative Stivers. Do we have Representative Stivers. It sounds like he is working on things. So really quickly, Dan, just wanted to mention, the question is, what are the chances that the HEROES Act passes? I think that's probably the most common question I've gotten from GFOA members and from folks around the community. So do we have a shot with HEROES? And I think that what's a very, very common response is maybe yes and maybe no. I mean, obviously, it's going to take some political discussion that come to consensus on lots of ideas. The legislation itself is an 1,800-page package. And so is it likely that 1,800 pages are going to make it to the president's desk? Possibly. But I think what's most important and what we've heard from our legislators so far is that they won't do it, or it won't pass unless they hear from us. And so the most important thing that we can do is to ensure that the legislators hear from us. And Congressman Stivers is no exception to that. It sounds like he is in the room. Do we have Steve Stivers live? Great.
Stage, it says. Oh, now I'm on the show. I was backstage. Sorry.
Well, now you're front stage. Thank you for joining us, Congressman Stivers.
Thanks, Emily. Great to be with you.
So, real quick, we can jump right in. As a leader in Muni finance issues, you've championed our efforts on advance refunding. And unfortunately, we noticed it was absent in the HEROES Act. How might we be able to support your efforts on that front?
Well, I'm hopeful that we can get some bipartisan communication and negotiations going. The HEROES Act was prepared in Speaker Pelosi's office exclusively with no input from Senate Republicans, House Republicans. She did get input from her own Democratic caucus in the House. And to answer the question you asked earlier, there is no way the HEROES Act as it's written will pass because Mitch McConnell has said it's dead on arrival in the Senate. Now, provisions that are in the HEROES Act might ultimately be in the final package, but the HEROES Act itself, I can tell you with no hesitation, will not pass as it's written today. And that's good news for folks that care about things like advanced refunding. Advanced refunding is an inexpensive way to allow municipalities to leverage these lower interest rates we have right now to actually get more bang for their buck. And so it's something that we could do and put in a bill. I also am hopeful that we can untie the strings that were attached to the original $150 billion of aid to state and local governments, where it had to be used only on Corona-19 funding. And, there are a lot of revenue shortfalls as a result of the economic impacts of COVID-19. So I'm hopeful that we actually can untie those strings and potentially add more money. I don't know what the right number is. I know there was $500 billion in the HEROES Act. That may be the right number, but if we untie the strings on the first $150 billion, we may be able to spend a little less than that to add to it. The other thing I would tell you is I am very hopeful that we will untie the restriction of population. The money only flowed directly to municipalities and counties above 500,000 people. That was a very arbitrary number. And frankly, the carnage didn't stop at 500,000 people. It's up and down the size of municipalities from, little towns in my district to, medium-sized cities like Wilmington and Lancaster and Chillicothe that didn't get any aid, to even big cities. And the big cities at least got some direct aid. So, Columbus and Cleveland are the only two municipalities above 500,000. And then there are, I think, 6 or 8 counties in Ohio above 500,000, and they got direct aid. The rest of the counties had to get the money sent to them through the state. And that's problematic, if you ask me, because it's just one more place that you can stop the aid. So I'd like to see the aid flow directly to everybody. I'd like to see it untying that population requirement. I'd like to see us untie the limits on the usage of the money. And I'd like to see us potentially add some money to it and do some things that don't cost that much, like advanced refundings that could actually leverage where we're going now. So I'm hopeful that we can work with the Senate and the House to make something happen. You know, that's happened in every other coronavirus package until this one. They were all negotiated, and this one just kind of popped out of nowhere. And that's why it got a partisan vote on Friday. So that kind of tells you its fate with the Republican Senate and a Republican president. So it'll have to be negotiated if we're going to make something happen. I feel like it can happen and we're going to get something done, but we got a lot of negotiations to go. I'd like to see it personally done before Memorial Day, and that's coming at us pretty quickly.
Thank you, Congressman. Is there an alternative as strong as the muni market for state and local governments to utilize right now?
Well, you know, the municipal finance market is really strong because the interest rates are great and there's demand. So I think if we could just, you know, again, allow things like advanced refundings and make sure that we maybe even ease some of the other restrictions on municipal bonds, then we'd allow our state and local governments to leverage a pretty amazing interest rate environment to really help grow their economies and build resources or infrastructure in their areas, whatever's important to them.
Thank you.
I totally agree. And you have a big audience here who totally agree with you on that as well. One thing that we talked about earlier on in the program, and many of our members are interested in, is your dear colleague of early May articulating a strong case for municipal market stability. Why is market stability important? And what happens when state and local governments have to rely on an unstable market?
Well, an unstable market won't always be there if a local government needs to have access to capital, whether it's to build roads, an airport, you know, refinance old bonds, whatever it is. That's why we need a stable market. And that's why so many of my colleagues, Republicans and Democrats, signed the letter to make sure that we actually got the Federal Reserve to step in and keep the marketplace stable for municipal finance. It's really important. And I got great feedback from the Federal Reserve staff. I feel confident that, you know, they're ready to do what they have to do.
Oh, that's really great news. We're very glad to hear that. And Congressman Stivers, is there anything that GFOA can do to help you pursue the initiatives that you have in the federal government?
Well, if your members would be willing to call their members of Congress and tell them why it's important to allow things like advanced refundings and what they would do with the ability to have advanced refundings, how much money that would leverage or save the local government that they represent, that would help as we try to move forward with this. Again, considering the HEROES Act costs $3 trillion, advanced refundings is a tiny, tiny cost compared to $3 trillion that was just attempted to be spent. I believe the final package will spend, may include trillions, but probably it'll be $1 to $2 trillion, probably not a $3 trillion price tag. So because of that, we need to do everything we can to leverage that money, and allowing advanced refundings allows state and local governments to leverage that money through the capital markets and at historically low rates.
Emily, with 21,000 members participating on this call, that's a pretty strong group that we can start reaching out to our congressional delegation to make this happen. So I encourage everybody on this webinar right now to think about it. Look at our website, our coronavirus relief website. Look at our Federal Advocacy Center and try to do that. It doesn't take that long. It's a real easy thing to do, and it's a way to really advocate on behalf of your own unit of local government.
Absolutely.
Congressman, we greatly appreciate your time today. And I will share very proudly, I've been married to a Buckeye for almost 28 years now, and I definitely outkicked myself. I definitely outkicked myself.
Me too. That's great. Well, thank you. And thanks for allowing me to be on with you. And please reach out to your members of Congress, because advanced refundings is something that we could do that would be simple and would really help our state and local governments in massive, massive ways. And while I do want to untie the strings of the current $150 billion and add some money to it, I would like to give you more tools in your toolbox, and that's what advanced refundings would do. So I'm hopeful that we can get this done when it's a bipartisan negotiated package.
Thank you for your leadership, Congressman.
Thank you. I'll keep working on it. And if anybody ever needs anything, please call me at my office. They can call me at 202-225-2015. And we've got folks forwarding the calls. And even though we're all working from home right now, let me know. I'm happy to help on anything. Take care. And thanks for allowing me to present to you.
Thank you so much.
I wanted to take a chance to quickly pivot to a matter very important to those of us managing access to capital in our jurisdictions. It's been mentioned several times prior to now that the Municipal Liquidity Facility, as Emily mentioned very early on through the CARES Act, Congress authorized the federal government to stand up a facility that would lend capital to state and local governments. Since the announcement of the Municipal Liquidity Facility was initially proposed by the Federal Reserve Bank of New York, it's gone through several iterations and developments. And here's where we stand as of today. Once created, the facility can lend up to $500 billion to eligible entities, which entail states, counties with a population over 500,000, and cities with populations over 250,000. On the term sheet, they also mentioned several eligible uses of the proceeds. It can be used for delayed revenues, revenues foregone, and also principal and interest on debt previously issued. Interested entities only have until December 31st to access the facility, and the debt has to have a specified term of 36 months or less, but can be paid back at any time prior to those 36 months. Emily, those are the key points. Are there other things I might have missed?
Yeah, just a couple additional details, Dan, from GFOA members as we're assessing this facility. The Federal Reserve has specified in its term sheet that the eligible entities can borrow from the facility on behalf of instrumentalities or political subdivisions that aren't listed as eligible entities. So, for example, it might be that a state would access the facility on behalf of a smaller local government, more likely a pooled group of local governments. Or it could be an eligible entity that's a city accessing the facility on behalf of a water or a transit system. However, they have also specified through both the term sheet and the frequently asked questions that it is the eligible entity's responsibility for the debt. So in the two scenarios I outlined, it would be the state responsibility for the debt and the city's responsibility for the debt. But finally, I did want to mention, I think the most important element for GFOA members was revealed last Wednesday. On that day, the Federal Reserve introduced how the facility would be priced, and you can see that on the slide up. I can say with GFOA members that there have been mixed reviews about whether it's an attractive facility for their jurisdiction. Obviously, there are still a lot of assessments to be done by local governments across the country and state governments across the country to determine actual need. We're at a precipice, and there is still a lot of forecasting and a lot of panels on forecasting ahead of you at the GFOA conference. But also, an important component for GFOA members, many states have a constitutional prohibition against jurisdictions borrowing for working capital. Changing state policy isn't exactly a quick or easy task. But thankfully, for better or for worse, there's still a lot of time between now and when the facility closes on December 31st. We're all very intrigued to know how this facility will be used.
Fortunately for us, we have the creator of the program here with us today. Kent, advisor of the Federal Reserve Board of Governors, has graciously joined us today to help answer still a few lingering questions about the facility. Mr. Haichu is a longtime member of the public finance community, most notably as the first director of the U.S. Treasury's Office of State and Local Government Finance. Personally, I think it's a great thing to have a person who knows this much about munis heading up this effort. I'm double checking just to make sure Kent is available. I'm seeing he's not in yet. I mean, Emily, I think if it's okay, maybe we'll talk a little bit about, some of the things what we're looking at in the state of Indiana for our local units of government. Fortunately, in the state of Indiana, we do have something called the Indiana Bond Bank, which was created to actually allow what we call a pooling of debt of local units of government. So the bond bank has a program right now for local units of government whose property taxes have been delayed to provide them funding in advance of those payments that may not come in until July. The way it would work is there could be 60 or 70 small units of government that need to borrow money. Instead of doing small offerings on their own in the open market where smaller unrated issues, access to the capital markets is limited, the bond bank pools all those small notes, puts them into a much larger note to sell in the open market. As we move forward with this program at the bond bank, I know the staff over there is looking at the open market sale, but also how the municipal liquidity fund can assist or is at least propping up the markets. I'll do a quick check for Kent. We're still having trouble getting them to come in. Emily, I think that kind of covered what I think we in Indiana are doing for these short-term notes and trying to explain what a pooled bond offering looked like. I would also agree with the thing you mentioned about being one of those states that has a constitutional debt limit. We cannot issue direct debt. We would be one of those entities handcuffed. And it would, you mentioned it would not be easy. It would actually require us changing the state's constitution to do that, which actually requires 2 legislative sessions. So it's not only a heavy lift, by the time the lift's done, I think by that time, our need for those funds, could be gone. And it would be a major, major lift for our legislative body and governor's office. So
yeah, and that's very similar to what we've heard from GFOA members as they're assessing this facility. Now, what I can say on the front end, you look at the facility and you think to yourself, well, the income tax filing date, for example, has been delayed from, April to July. And even still, I think there's a possibility that there he is, Mr. Haichu joined us. Just talking about the delayed income tax filing date, Kent. We have explained the facility thoroughly, and we have done your introduction. So we really appreciate you joining us here today.
Thank you for having me, Emily. I very much appreciate the opportunity to address your members. And even more, I appreciate the partnership that GFOA and you in particular have shown with the Fed during this stressful time and during this time of developing the MLF program.
Hey, Kent, I think one of the first questions I might have is why did the Fed Reserve recently intervene in the municipal market for the first time in more than 100-year history?
Thanks for that, Dan. Obviously, I don't have to tell this audience about the sharp liquidity-induced sell-off and the resulting interest rate spike in the municipal market in March that created unprecedented stress in both the secondary markets and, most importantly, to this audience, in the primary market new issuance. The Fed moved quickly on March 23rd. Those of you with variable rate demand notes outstanding know that the Fed opened its existing money market liquidity facility for variable rate paper, which immediately contributed to VRDN resets falling from what had been nearly double-digit interest rate levels on dailies to today, SIFMA's resetting at less than 20 basis points. We followed that up on April 9th when the Fed announced the $500 billion municipal liquidity facility that you're discussing today. And while the market has significantly improved since March, it is now characterized by much wider credit spreads as the market begins to assess both the near and longer term structural impacts of the pandemic on individual issuers. And as the chairman of the Federal Reserve has said on a number of occasions and in our press releases, we continue to monitor conditions in the municipal market to evaluate whether any other measures may be necessary and appropriate.
Thank you for that, Mr. Hichu. So what are the policy objectives of the Federal Reserve when it's seeking to, what are the policy objectives the Federal Reserve is hoping to achieve with the municipal liquidity facility? And if I can just pause and ask you to tilt your camera up a little bit higher, we're missing the top of your head.
Oh, that's okay.
There we are. That's where the brain is.
You're not missing much.
So just to repeat, what are the policy objectives of the Federal Reserve and what are they seeking to achieve with the MLF?
They're pretty straightforward. It's to provide ready access to liquidity funding for state and local governments facing unprecedented fiscal challenges resulting from the coronavirus pandemic. And that's why we designed the eligible use of the MLF note proceeds to be broadly defined to address cash flow management and liquidity needs. So that's our primary objective, is making sure that during this crisis, that from whatever source and from the MLF, if necessary, that state and local governments have sufficient liquidity to confront this crisis. The second is to help restore and support municipal market liquidity on the short end of the curve, similar to the impact that the MMLF had on VRDN pricing. But it's important to understand that we operate pursuant to our statutory authority, often referred to as 13.3 statutory authority. And consistent with that, the authority, the MLF is designed to serve as a backstop, not a first stop for issuers. Its specific purpose is to support the functioning of the financial markets rather than displacing it.
So Emily shared the pricing grid on our presentation a few slides ago. How was that grid was publicly released last week? How was that grid established for these notes?
Good question, and we've had a lot of those questions. Again, I'll turn to our 13.3 authorities, and we established the grid for the municipal liquidity facility in the same manner that the Fed has done for all of its other facilities during this crisis. And that authority requires that a penalty rate to normal markets be established to discourage its use, except during the words exigent and unusual circumstances are ones that you hear a lot because they come right out of our statute. As I said, the MLF pricing has been established to serve as a backstop, not a first stop. And I think it's important to understand when we look at our definition of normal markets, those markets are measured over a reasonable historic period, not the single point in time immediately preceding the onset of the coronavirus-induced muni market sell-off. So the penalty is designed to make sure, as we said at the outset, that state and local governments have access to liquidity, but it's not designed to replace market sources. And as I'll suggest in some comments before we end, it appears that there's significant liquidity available to high-grade issuers in the municipal market today that didn't exist a month or so ago. Mm-hmm. And as I said, we continue to monitor the municipal market and may make MLF pricing grid adjustments in response to any material changes in the marketplace.
Thank you. So top of mind question for a lot of our members, when will the MLF be open for business?
Really today. Let me just review. Our FAQs went out last month. They were supplemented, in which the program was dramatically expanded in terms of eligibility. On Friday, we issued last Monday, we issued the pricing grid and follow-up FAQs a week ago. On Friday, what's called a notice of interest was published, which effectively opened our pipeline so that issuers can begin to express their intention to use the MLF. And this morning, we published the application and the legal documents that issuers whose NOIs are approved will be invited to submit the application, and everyone has full transparency over the note purchase agreement that will go along with our facility to secure the notes. We expect once we begin getting notice of interest and approving applications that we should begin purchasing notes in the very near future, certainly within the next several weeks. I would emphasize with regard to the application and the turnaround, we do propose to have we expect to have very quick approvals of both the NOIs and the applications, assuming that issuers propose straightforward credits that are consistent with the MLF FAQs. As you know, we have a number of vendors, outside counsel, and administrative agent who are working with us, and we have drop boxes for questions. And so we encourage all issuers who believe they need liquidity from the MLF to use those resources.
As this moves forward, what measures will the Fed use to gauge the success of the?
So, as I mentioned at the outset, our primary objective is to ensure that state and local governments have adequate access to liquidity under reasonable credit terms during this crisis and the ensuing economic recovery. None of us know today whether the recovery will be V-shaped or take much longer, or how deep it will be, but the MLF is available through the end of this calendar year as a facility that state and local governments can access as they begin to see what the outcomes are of this unprecedented crisis. And so to the extent that such liquidity is available, either directly from the MLF or through banks and the capital markets, we believe the Fed will have met its objective.
Kent, one thing I would add is the flexibility of repayment is also an important thing to highlight for our members that are listening. You know, the length of the note can be up to 36 months, but if conditions turn around right or delayed revenues come in sooner, it does give these entities the ability to prepay with no penalty, correct?
Absolutely correct. Thanks for pointing that out. And I would also say, as our chairman has said a number of times, that monetary policy can only go so far in addressing the fiscal impacts of this crisis on state and local governments, that ultimately fiscal policy will be necessary. And the last thing we want to see is have state and local government balance sheets loaded up with deficit financing that could hinder their ability to provide the essential services and infrastructure financing that we as a nation depend on going forward. But to follow up, we believe there's preliminary evidence that the totality of the Fed's interventions, including the MLF, are already having a positive impact on issuers and the municipal markets by just the mere announcement of the facility. As you know, interest rates for high-grade credits have fallen dramatically. Secondary market trading has improved, and the new issuance calendar is once again being absorbed by the market. Just for your members, the ones that follow the market closely, I think, are aware, as of today, the AAA Muni benchmark index is now lower at every point across the yield curve than it was in early March before the crisis. That's not to say that we're out of the woods yet, but for high-grade issuers, the market seems to be functioning well. On the lower grade side, after being pulled from the market 2 weeks ago, Illinois was able to come back and raise $800 million of long-term debt last week, albeit at high rates. It's rated BBB-, but it was just 2 days after the release of the MLF pricing grid. And we understand that pricing grid being available was an encouragement to purchasers of Illinois GO bonds on the long end, knowing that Illinois would have access to liquidity through the MLF program. And then lastly, I'd point out that we understand that bank facilities, which are an important component of this whole effort, In just the last 6 weeks alone on Emma, we've seen twice the number of such filings for bank facilities as were reported in the entire first quarter of this year. Anecdotally, we are hearing that banks are stepping up to the plate, and that's a positive sign. But I guess I would close by saying we're interested in getting your feedback from directly or through GFOA in terms of the pockets of need that are out there and how we can adapt the MLF program going forward to achieve the objectives that I've outlined in this short interview today.
Kent, we know you are remarkably busy and appreciate the work that you've done. Although this might not be the right program for everyone, I think we can all agree, I know we all agree, that it's a step in the right direction. We thank you for lending some of your time with us today.
Thanks, Emily and Dan. Have a great conference today. It's a brave new world. People do you have participating today?
I believe we're in the thousands.
Oh my goodness.
Congratulations. We should have warned you that before we brought you in.
Thank you.
Have a great day.
Thank you.
I'm glad we had a chance to visit with Kent, and I agree with you, Emily. This may not be the right program for everyone, but I can agree it's moving things in the right direction. Underwriters we work with are showing there's just ability in the long-term part of the market on the primary side. I do agree as we monitor rates, they are back to where they were to early March, and that's helpful to see. And as I already mentioned, we've also seen our variable rate demand portfolio, which was in double digits, drop down to the 20 to 25 basis points now. There was an interesting ride, but we rode the wave down, and now we're back to reasonable rates. So I would concur that what the Fed has done, and while the MLF may not be there for everyone, it did do a good thing to stabilize, I think, not only the short-term part of the market, but maybe even the longer term deals also based upon the research we're getting.
Yeah, the way that it's created, interestingly, it seems like it would situate a state that does have a bond bank type of facility, an intermediary of some sort. You mentioned the IBB, the Indiana Bond Bank, will pool small notes for locals. Is that what I heard you say?
Yeah, that's correct. I think the hurdle for the bond bank program, and you mentioned it, is the issuing entity is, it's going to have to be on. They're going to have to provide some level of credit enhancement or something like that, or their rating. And in a pooled bond offering, that can get a little difficult, but it is being reviewed by the bond bank staff and professionals right now.
Sounds like there's still a little bit of development, although they are open for business very, very quickly. So if you'd like more information about the municipal liquidity facility, please do reach out to us in Washington, and we will get you connected and make sure you have all the documentation that you need. So that kind of brings us to today.
Yep. I think what's fair is that it became throughout this meeting and other things that I've seen is that GFOA is an incredibly influential brand in Washington, D.C. We have not seen the federal representatives and senators participating. Were we not? I think that reflects the strength of our 21,000 members, and it proves that GFOA and our staff in D.C. and Chicago are thought leaders when it comes to all things in public finance.
Thanks, Dan. But we don't do it alone. In GFOA, together with a lot of national associations that were mentioned in previous conversations earlier today, the National Association of Counties, National Governors Association, National League of Cities, we host what's called the Public Finance Network here in Washington, D.C. And so we augment our strong financial voice of state and local government finance officers, along with our elected organizations as well, just so that we have an echoing voice through the halls of Congress. But we also absolutely depend on our membership, as Congressman Stivers mentioned, reaching out to elected officials to keep them connected with boots on the ground. As Congressman Schneider mentioned, it's sometime a teachable moment, sometime an opportunity to help them understand what's happening in your community. You know, you don't have to necessarily know the bill number. You don't have to know the text. Even some outreach on what will help your local jurisdiction is so incredibly important at this point in time.
The GFOA website has always been especially helpful to me. We've got our best practices and advisories out there, but now more important than anything else is the Coronavirus Resource Center. When I need to get some information or I have questions get asked to me by others, since I know I am not the expert, I can refer others in local and state government to look at the GFOA website, especially the Corona Resource Center. And it does help me keep up on the issues. And also when I need to reach out to my members of Congress in Indiana, I feel like I'm pretty well versed. So for the 1,000+ members who are on the webinar right now, you know, this is an important tool you can utilize. It takes a few clicks. And if you do have questions, there are 3 staff in our Washington, D.C. office. If you've got legislative questions or other things, they're more than happy to try to reach out to you and figure out the next right steps.
Agree. As you said from the very beginning, Dan, we represent all governments across the United States, and we are your advocate in Washington, D.C. Our resource center is fully stocked and daily stocked with links that are helpful to governments working through this pandemic. A fair amount of GFOA members have just sent me emails saying, Emily, what do I qualify for? How might I be able to navigate this entire package, this stimulus conversation on behalf of my local government? Certainly would point you toward the Coronavirus Resource Center, but very happy to make that connection. And if we can be an additional resource, we're ready and willing, absolutely, to help connect you with your member offices and provide you the names, email addresses, and phone numbers to your representatives.
I think one of the best things we can do as finance officers is communicate with one another. You know, and this is one where I'll tell folks that you know, the applications to be on one of the many subcommittees that work on behalf of GFOA. They'll be taking applications for those, I think, and through till June 30th. It's a really important way to get involved. I've served on the debt subcommittee and the economic development and capital planning subcommittee. 1, I've learned a lot. 2, it gave me relationships that I continue to utilize to this day, even though I'm not on those committees anymore, when I need to bounce something off someone or have someone to be a mentor or I can help. So I think those are a couple of things I would mention. So I'd also ask you to take a peek at the agenda for this virtual conference. Find a session that you need, for the skills for your job. But I also encourage you to look a little further and find one of those sessions that you don't think makes much sense for you, and step out of your comfort zone and go ahead and utilize one of those also. Consider brushing up on your COVID disclosures, budgeting in a recession, and others that provide the best practices to start right away. Now's the time, and if anything this panel has provided, the inspiration that you need to know that your voice, your expertise, your knowledge, and especially your dedication to excellence in public finance is especially meaningful as you guide your communities through this pandemic. As I say about a lot of issues, there's a beginning, a middle, and an end, and we will get to an end, and we will do that together. Thanks so much for your attention today, and hopefully next time we'll see everyone in person. Best wishes for the safety and well-being of your communities, your family, and enjoy an excellent conference experience ahead. Thank you very much.
Thanks, everyone.